The S&P 500 is up over 88% in the past 5 years, but Invesco's QQQ is up over 155% during that exact same time. So for a $10,000 investment in each of these, one gets you $18,000 and the other is over $25,000 over those same 5 years. Which makes it no surprise that QQQ is the most popular ETF that's traded on the NASDAQ, and it's the 4th most popular exchange-traded fund worldwide. But are you familiar with QQQY and another iteration called TQQQ? Would you be surprised to know that one of these ETF is considered to be one of the highest dividend yield funds year to date at over a 12% dividend yield? And remember in the intro of the video where I mentioned that QQQ outperformed the S&P 500 with a 155% 5-year return? Well, one of these funds has a 5-year return of over 300%, which means that that $10,000 invested would have been worth over $43,000. And it's true, I only pointed out the rosy highlights, sort of like an online dating profile that somehow makes an ugly troll look like Prince Charming. But to be fair, most of these funds also have a very dark side, sort of like that Irish friend that we all know and love who suddenly turns into Dr. Jekyll and Mr. Hyde every time he drinks whiskey. And yes, QQQ does have a little bit of a dark side, some might even call it mini. Now, I don't want to waste your time, so here's the layout of what I plan to cover. I'll review each of these funds in depth as a comparison, starting with their strategies. Then I'll go over the holdings for anyone that may be new to QQQ. And I'll provide some commentary about why their top holdings make it very much worthwhile to have in your portfolio, because the future outlook is very strong for these companies. Then I'll cover the key metrics as a comparison of each fund. And then I'll finish it off with the pros and the cons, which will then bring all that information together. I'm going to start off by addressing that elephant that's in the room, and that happens to be that the fund I don't have in the thumbnail or the title. And that happens to be the fund QQQM, or as it's often referred to as the QQQ Mini. It's essentially identical to the QQQ Trust Fund, and it was recently released in 2020. And since released, it has had a slightly higher return in the 1 and the 3-year returns over the original QQQ. Both strategies are the same, the holdings are the same, but the only major difference between the two is the expense ratio, which is 0.2% for the QQQ Trust, and it's only 0.15% for the QQQ Mini. Now, if you already own the QQQ, I wouldn't go out and sell it and convert it to the Mini, but if I were a person that was looking to invest in QQQ for the first time, I would personally choose the QQQM because over the long term of several decades, it's going to have a slightly better return. Let's get started by discussing the strategy of each of these funds. The Invesco QQQ or the QQQM, they both have the strategy of tracking the NASDAQ 100 index, giving a person access to the performance of the 100 largest companies that are listed on the NASDAQ, where the fund and index are rebalanced quarterly. Now I'll take a moment and I'll move on to the next fund of the ProShares Ultra Pro QQQ with the symbol TQQQ. It seeks daily investment results before fees and expenses that corresponds to 3 times the daily performance of the NASDAQ 100 index. This is referred to as a leveraged fund, where the strategy is meant to have these funds for very short durations and not for a long-term investment strategy. With it being leveraged with a 3 times performance, that means that the performance boost goes in both directions. Just like the Expedition Everest roller coaster at Disney, that's really going to catch you off guard when it starts falling backwards. For example, when we look at this daily performance chart, the light blue is the NASDAQ, and the dark blue is the TQQQ. On the 26th, the NASDAQ was up 1.65%, and the TQQQ was up 4.92%. And the next day, the NASDAQ was down 1.93%, and the TQQQ was down a negative 5.81%. Hey, if the index is up, then TQQ is up about 3 times that. But if the index is down, then TQQ is 3 times worse. That means that the good times are great, and the bad times are hair on fire horrible. Well, I don't have hair, but they'd be horrible. As for the strategy for the Defiance NASDAQ 100 Enhanced Options Income ETF with the symbol QQQY, it is to provide monthly income by actively placing bullish bets on the NASDAQ 100 index through a 0 DTE put option writing strategy. 0 DTE is an options contract set to expire at the end of the current trading day, and it stands for 0 days to expiration. This fund happens to be actively managed, And its goal is very different from the other two, since it is trying to provide a monthly income in the form of a dividend. And when we list out the three funds, it's very obvious that they are all quite different in strategy. Since all of these funds are built on the foundation of QQQ, then I'm only going to speak to this one particular fund's investment sectors and its top holdings. And please feel free to skip ahead if you are not interested in the least in the holdings or in my commentary on those particular companies within the QQQ. Because it is based on the NASDAQ 100 index, the sector breakdown is only 50% technology, and then communications and consumer cyclical combine with it to make up 80% of the total fund. And when we look a little bit deeper under the hood at some of those top holdings, this is most of the top players driving the growth in the entire overall market, with the likes of Microsoft, Apple, Nvidia, Amazon, Broadcom, and Google. And not that you need a reminder, but Microsoft has been one of the very first major companies to monetize artificial intelligence in some meaningful way, where they launched their AI Copilot to both enterprise and individual users over the past 6 months, where it provides a chatbot-like experience that you get from ChatGPT right into the suite of Office tools, where Excel can now create features and formulas just from a basic prompt without a person needing to memorize how to use all those formulas and functions. And a person can ask PowerPoint to create an entire presentation from simply referring to a prior written document. And if you're curious what this is worth for Microsoft, well, one group estimated that for every 10% of Office users using Copilot, it's going to result in $14 billion in revenue to Microsoft. And with regards to productivity, one survey stated that meeting recap productivity is up over 300% by using Copilot, and all other areas are really close to at least a 50% improvement. That level of productivity is going to be a major boost to all companies that at least choose to use it. And let's not overlook the fact that QQQ has at least a 6% stake in Nvidia, which is up over 200% in the past year alone, and analysts still predict it to have over 11% upside for the rest of this year. The overall point is that QQQ has a great set of holdings, and given that AI has an estimated compounded annual growth rate of about 36% over the next 10 years, there's a lot of room for growth within these funds. We all know that index funds offer diversification within stocks, but a portfolio with a mix of asset classes can provide even more protection against volatility. A 2022 Citi report highlighted blue-chip contemporary art as an asset class with a negative correlation to developed market equities, like stock. The overall art and collectibles asset class is estimated at almost $2.9 trillion by 2026, which is leaving plenty of room for upside. That's where today's sponsor, Masterworks, offers an art investing platform for investors to diversify into blue-chip paintings by purchasing shares, without needing millions or having art expertise. Previous offerings included Picasso, Basquiat, and Banksy works. Masterworks has distributed over $55 million in proceeds across 22 exits, and it's nearing $1 billion in invested capital, and offerings can sell out quickly. So if you're interested in learning more and you want priority access, you can use the QR code right here on the screen, or you can use the link right down in the description. And as a reminder, past sales and offerings demand, they're not indicative of future results. All investing involves risk. Now I'll move on to the key metrics of comparing each of these three funds. In looking at QQQ, it has a total holdings of $268 billion with a 30-day average volume of 43 million. This is a very good indicator of liquidity and a person's ability to sell this fund if you need to. Next, the expense ratio is at 0.2%, which is fairly low, and it's what I would expect from a passively managed index fund. This fund's dividend yield is a bit small at 0.58%, but once again, that's not unexpected since this is made up mostly of growth companies that simply choose to reinvest their profits back into their business versus providing a dividend. Now, I do want to point out that their beta is at a 1.19, and if you've forgotten, the beta is a measure of volatility of the fund compared to the market. And since this fund is at a 1.19, it is theoretically 19% more volatile than the market itself. And another item that I want us to review is the standard deviation being at a 0.06, which is the statistical measure of the market volatility, measuring how broadly prices are spread from the average price. If prices trade in a narrow trading range, then the standard deviation will return a low value, and that indicates low volatility. Now let's begin to compare the other funds to the QQQ, with it being the foundation. The QQQY fund has a holding of 248 million with a 30-day average volume of 511,000, both of which are substantially less than the QQQ, and it has a much lower liquidity. And because this is an actively managed fund, the expense ratio is at the top of the charts at 0.99%. But the biggest shock is the dividend yield being at a whopping 46%. And no, that is not a typo. It is truly 46%, and it is one of the highest dividend yields that's offered in any ETF. Now please keep in mind that the strategy of this fund is to create income by leveraging zero trade options. And another interesting factor is that the beta is at 0.52%, so this is considered much less volatile than the market itself, and the standard deviation is also fairly small at 0.03. Just a reminder that I will be covering the pros and the cons at the end of this video, and I'll also provide use cases on why and when you might want to be using each of these funds, if at all. But for now, I'm going to bring in the TQQQ fund for the final comparison. And as you may recall, the TQQQ fund is the one that happens to be leveraged 3 times over the QQQ. And honestly, I was extremely surprised to learn that this fund has a holding of $22 billion, and the 30-day average volume is over 68 million. I'm genuinely shocked at how popular this fund is, and the fact that it carries so much liquidity. Let's quickly look at the expense ratio, which happens to be 0.88%, which is a bit high in my opinion, but it is a managed fund that's offering 3 times the exposure to QQQ with a lower investment. And the dividend yield happens to be at 1.09%. And now things get very interesting when we look at the beta at a 3.58. This is wildly high and is exactly what you would expect with a 3x leveraged fund. The volatility is going to be wicked high, and you need to know that going into it. But I'm going to speak more to that in just a minute. Before moving on, I have a favor to ask of you. If you like my content, please consider hitting the like button so my channel could continue to grow on YouTube. And better yet, I'd love it if you'd subscribe so you could be up to date with all of my latest content. These 3 funds, they're all based on the foundation of QQQ. But with one of them, they happen to have a focus on generating income, and that happens to be by means of a dividend. And then there's another one, which is a 3 times leverage version, which happens to have 3 times the potential gain. And of course, that means it has 3 times the risk of loss. And a question that you're probably asking yourself is, what are the reasons for wanting each of these funds? And would a person even want all 3 of them? First off, QQQ is an amazing growth ETF, and it is popular for all the right reasons. The pros is that it is consistent, and it is a sure thing. It's been around since 1999, and it has blown the S&P 500 out of the water during that time. It's an extremely low-cost exposure to the NASDAQ 100 index. It has one of the best liquidities of any fund due to its popularity. And it also has tremendous growth opportunities given its high-tech holdings that stand to grow a ton from AI. As for the cons, well, the biggest con is that the QQQM, or the Mini, is a much lower cost version of the QQQ that I'd recommend first and foremost over the QQQ. The next con is that it is heavily focused on one particular sector, technology. It also has a limited number of companies, which can create wild swings within its performance. And one could argue that it lacks diversity. As for the use case of owning it, I honestly believe that everyone should probably have this fund because it really checks all the major boxes for high growth, low expense, low volatility, and high liquidity. Now I'm going to move on to the Defiance NASDAQ 100 Enhanced Options Income ETF, with the biggest pro being that it has a dividend yield of over 46%, and that its beta and its standard deviations are extremely low. Sadly, that's about the only pros that I can give it. As for the cons, well, first off, it's only been around since September 2023, so it lacks really any form of history. Next, the expense ratio is the highest of the 3 at 0.99%, and the holdings and the volume are the lowest, which means that it has the lowest liquidity of the group. Despite the high dividend yield, the overall return year to date, well, it's only at 4.2%, which, if you're begging what I'm raking, that means that the fund's price is going down faster than the dividend yield can keep it afloat. And that is also apparent when you look at the max performance. So what exactly is the use case for this fund? In my opinion, There is no good reason to have this fund. Why would I in good faith pay an expense ratio of 0.99% just to have this fund lose 25% of its value in the first year? Even if it does have a dividend yield of 46%, that doesn't really give me much. Now, if this fund could stabilize its losses and create some form of a steady income stream from those options that are over and above the index price of the fund itself, then hey, I'd be on board. But for now, based on what I see, yeah, it's a hard pass. Now let's take a moment to look at the pros for the Pro Shares Ultra Pro QQQ. Okay, that is way too many pros. Where it has extremely strong liquidity and the performance has outperformed all of the funds from today. If you were to compare the entire group, you'd see that this one blows them out of the water at most every time period, except over the 3-year total return. And that's because the markets took a major dive in 2022. And since this is a 3x leveraged fund, it took an even steeper hit than all the others. Another pro is that it offers significant returns in a shorter holding period. If the NASDAQ happens to be moving in a net positive direction, then hey, this fund wins. As for the cons, well, the obvious one is that the losses come in at 3 times higher than the index. The expense ratio is also quite high at 0.88%, and it's not meant to be a buy and hold strategy. Instead, it's meant to be for a short-term holding and constant management and review from the investor themselves. In general, it comes with a boatload of higher risks. It's sort of like Evel Knievel or Johnny Knoxville trying to buy life insurance. It's almost like gambling. As for its use case, this is one that if you have the time to watch and manage it, it could provide you with some substantial gains without you having to be a day trader. A person could certainly see how it does over the long term, but for me personally, I wouldn't be willing to risk too much of my portfolio into a leveraged fund. In this case, I would invest sparingly in this space. A lot of the decisions and the use cases for these funds, well, it really comes down to your age and your appetite for your risk. And that's where I think that a lot of you may get a lot of value from this particular video on the best portfolio by age. And yes, the number 8675309 is in reference to a phone number. In fact, I try to have Easter eggs in most all of my videos where very few of them to date have been found. But hey, good luck finding them. Thanks so much for watching.